I'm excited to be able to have Bill join us today. What we did is that we went to all these different floodplain managers in all the different states across the country just to see if we could get them to present to our agents in these states from a different perspective. So Bill works in New York, and he's been doing this for so long, and he's so familiar with the area and the challenges that all of you have in that area. And so we thought having the perspective of somebody that truly knows what you guys and what your customers face every day was very, very valuable. So I do have a slide up about Bill. He is a consultant, and I'm going to butcher your last name, Bill, so I may just let you go through this. He's got a ton of experience, and I'm going to go ahead and we're going to give the screen over to Bill so that he could talk a little bit about his experience in flood and what he currently does. But Bill, you've been in flood for what, 20, 30 years?
Let's see, about 25 years, 24 years.
Yeah, a wealth of knowledge. So Bill, we're going to go ahead and turn the screen over to you so that you can pull up the PowerPoint, and then we'll go ahead and get started. So I'd like to turn the floor over to you.
Okay, and I'm trying to share my screen, but it says you cannot share screen while other participant is sharing. So I think you have to end sharing and then I can share.
Yeah, there you go.
Okay, and then share screen. And let's find, okay, I think this is the one I want to share. And hopefully you're all seeing the title slide.
Yep.
Okay, and bear with me just a second because there's another screen. Okay, here we go. I'm ready to go. So I'm pleased to have the opportunity to do this. When I was first asked to do it, I thought, well, I'll talk a little bit about flood insurance. We only have about a half an hour for me to present, and the idea is that we'll present for about a half an hour, and then we have a half-hour window where we can do some Q&A. So this is a partnership, this presentation, between National Flood Services and the New York State Floodplain and Stormwater Managers Association. I can speak for the latter. The New York State Floodplain and Stormwater Managers Association is a not-for-profit professional association dedicated towards reducing the loss of life and property from flooding while maintaining the beneficial function of floodplains. My own background, I worked for the New York State Department of Environmental Conservation. Actually, I started working for them in 1986. And then moved over to the flood program in 1996. And then in 2001, I took over as the section chief for the floodplain management section, working out of Albany, but with a statewide responsibility. I've also been active with the two professional associations, both the Association of State Floodplain Managers, where I had the opportunity to be chair for 2 years. I'm currently on their board, and I'm also co-chair of their Floodplain Regulations Committee. And I've been active in the New York State Floodplain and Stormwater Managers Association. And if you were to go to nyfloods.org, the website has recently been revamped, and you can find out all kinds of information and become a member. It's very inexpensive. You could be an individual member for $30 a year and be able to keep up to speed on changing issues within the realms of floodplain and stormwater management. And also, I see that Ricardo Lopez Torrijos is on the call, and he's our current chair. And he asked me how to pronounce my name. It's, if you turn the H into a K, you'll get it right. It's pronounced Nechamen. So we'll start out with a little bit of history. The National Flood Insurance Program dates back to 1968. And prior to that, private insurance companies got out of the business of offering flood insurance. The risk wasn't well understood. Damages were huge when there was a big flood. And it was not considered a cost-effective business. Prior to 1968, federal actions related to flooding were primarily responses to significant events, and primarily using structural measures, dams, levees, and so forth, to reduce flood damages. Despite that, flood losses kept on increasing. As a result, federal policy and approaches to flood control were redefined. Uh, there was a lot of debate about this for years, but it culminated in 1968 with the passage of the National Flood Insurance Act. The intent of the program was to reduce future flood damage through local floodplain management laws and to have the people who live at risk pay for the recovery through an insurance mechanism. And this is a federal insurance product. Nobody can be denied access to insurance as long as the municipality, what FEMA calls a community in New York would be a town, city, or village, legally participates in the National Flood Insurance Program. But for the next few years, nothing much happened until Hurricane Agnes hit in 1972. And there might be a few people on the call that remember it hit the Appalachian states and the southern tier of New York State very hard. At that point, it was clear that many flood-prone communities needed more incentive to join the National Flood Insurance Program. I was a student in those days in Amherst, Massachusetts, and I could remember signs going up in the farm fields by the Connecticut River that said, federal government controls Hadley land. Hadley was the name of the community next to the Connecticut River in Massachusetts. I didn't know what this was all about. What it was about was the beginning of the National Flood Insurance Program, which was saying, okay, local community, we can offer federally backed flood insurance in your community, but in return, you have to promise to enact and enforce regulations that manage development in the floodplain so that new development is at less risk. So 1972, Agnes happened. Nobody had flood insurance. Not very many communities joined the program. So they passed the Flood Disaster Protection Act in 1973. That led to an acceleration of flood insurance studies and flood maps. It led to a notification of flood-prone communities that, that there was a flood risk in their community. And it enacted the first mandatory insurance purchase requirement. And what that was that if you were to get a loan from the federal government, an FHA loan, something like that, and the structure that the loan was for was in a floodplain, you were required to purchase flood insurance. The other thing that brought a lot of communities into the program is that it said that if the community does not participate in the National Flood Insurance Program, bypassing a set of local laws to manage flood risk, then in the event of a federal disaster declaration, no federal assistance would be available for any building within the mapped floodplain, what we call the special flood hazard area. When I first got into the program at DEC and I would go through some of our community files, we didn't have things digitized back then. They don't have that many things digitized now. They still have banks of community files. And I would pick up a file for a community and I would go back to some of the historic notes and I would see newspaper articles from the 1970s and 1980s discussing the controversy of getting the community into the National Flood Insurance Program and having to issue some land use controls, which particularly in rural communities was a new concept. But at the end, most of the communities said, well, we don't want to do this, but we don't want to lose the possibility of federal assistance. So it was the late 1970s to the mid 1980s that most municipalities in New York State entered the National Flood Insurance Program. Now, 1993 was the Great Mississippi River floods, and you can see kind of a trend here, which is broken down in recent years. But the trend is that after a major flood event, you would get some changes in the program. So the National Flood Insurance Reform Act of 1994 expanded the flood insurance purchase requirements. Those requirements apply to any lending institution that is regulated or insured by the federal government. Requires the lenders themselves to determine if a structure is located in a flood hazard area. Also says that if there is a disaster declaration and somebody gets direct assistance from the federal government, what they call individual assistance, a condition of obtaining that individual assistance, and it doesn't come close to matching what flood insurance can match. The maximum individual assistance grant is in the neighborhood of about $30,000 to $32,000. The average grant is more like about $10,000 to $12,000. It's not meant to make people whole. It's really meant to give them a start in repairing their homes so that they can have a place to live. So it said that in the 1994 Act, if you receive one of these individual assistance grants and you're in a mapped flood zone, what we call the special flood hazard area, you have to obtain and maintain flood insurance for the life of the structure. And if you don't, further assistance is not available. We noticed that in 2011, I sometimes still live in the 20th century. In 2011, when Hurricane Lee hit in the southern tier of New York, that was 5 years after a major flood in 2006, and they were in the Susquehanna River Basin. And there were people that got assistance in 2006, did not maintain their flood insurance, and were not eligible for a second round of assistance. The other addition in 1994 was increased cost of compliance. And I have a slide later that talks about that a little bit more, but it provides an insurance mechanism to assist with the process of bringing a structure up to flood standards after it has been substantially damaged by a flood, meaning it was damaged to more than 50% or at least 50% of its market value. So where does this apply? Well, we have flood zones, and it's a complicated program. 2 weeks ago, I did 6 hours of training on the program. So you can't do the whole program in a half an hour. But the basics of the program are pretty simple. There are 3 flood zones. There's an A zone, or a zone that begins with the letter A, has a 1% or greater chance of flooding every year. That equates to about 26% chance over any 30-year period. The zone is either an A by itself or an A with a letter or number after it. The other zone is a V zone. In New York, it would be a VE zone. That's a coastal area that has at least a 3-foot wave. And also there are flood insurance requirements as a in condition of a mortgage. The requirement is that the V zone is an area with a 3-foot or higher wave, or an area seaward of a primary frontal dune. And I see I have a typo here. The third zone is the X zone, which is everything else. In the older maps, it might have been called a B zone or a C zone. In the newer maps, it's a shaded X or an unshaded X. The shaded X zone has a gray shading or black shading. That has typically called the 500-year flood zone. But I used to think a 500-year flood was the flood of biblical proportions. I would call it the FBP because we're full of acronyms. But in truth, it's the flood that has a 0.2% probability of flooding every year. That equates to about 6% over 30 years, which is greater than the probability of a fire large enough to require an insurance claim. Zones beginning with either an A or a V are special flood hazard areas. So what do they mean? And what are the insurance requirements and what are the development requirements? So if it's an A zone or begins with the letter A, the development must be reasonably safe from flooding and the lowest floor must be elevated. Mandatory insurance exists. If it's a floodway within a zone A or an AE, which is an area of a higher flood risk, there's more stringent development requirements. There actually has to be an engineering analysis prior to development. Mandatory insurance would still be required. If it's an A zone along a coastline, and it's within an area called a limit of moderate wave action, that's an area that has a 1.5 to 3 foot wave. FEMA maps that. It's usually a narrow zone landward of the V zone. There are no additional FEMA requirements, but building code, and particularly New York State building code, which uses the International Building Code, requires higher standards, very close to V zone standards. If it's a V zone, it must be elevated on posts or piles, open below the lowest floor or breakaway walls, and again, mandatory flood insurance as a condition of a loan from a federally regulated lender. If it's a shaded X, 500-year flood zone, mandatory insurance is not required, but it's highly recommended because it's still an area that can flood. And if it's an unshaded X or C zone, it's beyond that 500-year flood zone. No FEMA requirements, usually no local development requirements. However, FEMA flood maps do not map every area that can flood. So based on local conditions, flood insurance may still be recommended. So the mandatory purchase was introduced in 1973. It applies to federally regulated lending institutions, and it applies to the origination, increase, extension, or renewal of a loan for real property in a special flood hazard area within NFIP participating communities. Not every community participates. In the northeastern states, almost all of them do. And also the requirement is if the structure is in whole or in part within the special flood hazard area. If part of the land is, but the structure is not, then flood insurance is not required. So there's obligation on lenders. They're allowed to escrow premiums. They can force place coverage if the property owner does not purchase their own coverage. If you're going to one of the major national banks, I strongly recommend that you encourage your clients to buy their own coverage, because when the lender force places coverage, they might do it through their own subsidiary, might charge a rather high handling fee. Much better for the insured to go to their insurance agent. Hopefully their insurance agent is licensed to sell the National Flood Insurance Program products and purchase insurance on their own. There are enhanced flood hazard notice requirements. The lender has to give notice to the property owner. And there's life of loan requirements, so that if a map changes, the lender has to determine, well, gee, has a structure been pulled into the zone? Sometimes a map changes and a structure is removed from the zone. And generally, nobody tells anybody. So it's really up to the resident to kind of be aware of that and to either hopefully not cancel their insurance coverage, but at least go to a less expensive coverage. There are flood zone determination fees. It's usually about $25 for the lender to make that determination. Many of them go to national determination companies that do the determinations and also handle the life of loan determination coverage. And it also in 1994, again, tightened requirements for disaster assistance. What kind of lenders? Federally regulated, insured lenders, government-sponsored enterprises for housing, Fannie Mae, Freddie Mac, any direct federal agency lender like the SBA. The flood insurance requirements apply to lenders, so they can be fined. They can be audited by FEMA or the Federal Insurance Administration and be fined if they don't do this. And the flood insurance is a condition of the closing. The problem is a lot of times the insured or the purchaser or the structure doesn't become aware of this until a day or so before closing. And then we used to get a lot of panicky calls at DEC, and the people still there probably still get them. What if the community does not participate? Well, a private lender may issue a loan. However, the federal remortgage companies won't back the loan. It won't go anywhere in the secondary market. Fortunately, there are very few communities in the Northeast that do not participate. The flood insurance must be maintained during the term of the loan. Now, if you don't have a mortgage, nobody's going to make you get flood insurance unless you get that disaster assistance. A lot of people drop their insurance when their mortgage is paid off. Not a good idea. So the lender responsibilities are to determine if the building is in a special flood hazard area, document it, provide notice, require adequate insurance coverage. Now, FEMA regulations require insurance up to the value of the loan, or for a residential 1 or 2 family house, up to $250,000, whichever is lower. And those limits have not been raised in many years, so it is completely insufficient based on the value of housing in much of the country. So they must require adequate insurance coverage. For people that go above that 250,000, generally they go into the private sector for the excess coverage. They're allowed to escrow. They need to follow up if there are changes to the maps and can force place insurance. And we talked about disaster assistance. If somebody gets disaster assistance and they're within a special flood hazard area, they must purchase flood insurance for the life of the structure. So what if it's not required? You don't have a mortgage. You're not in a special flood hazard area. So you're trying to market flood insurance who think they don't need it. I'd gotten phone calls when I worked at DEC. I had gotten phone calls from people that said, I was told I can't get flood insurance because I live in a special flood hazard area, or I was told I can't get flood insurance because I don't live in a special flood hazard area. Both of those statements are false. But they're only required to get flood insurance if they're in a special flood hazard area and they're getting a mortgage. So if those conditions don't exist, well, maybe they're in a 500-year flood zone. There's still a very real risk there. As I said, it's greater than the risk of fire. You may be in an unmapped area that's prone to flooding. FEMA does not map every flood risk. They don't map small catchment areas, smaller than 1 square mile, small watersheds. They don't map urban storm drainage areas. And you see after large storm events, low-lying areas of cities often have street flooding, which often damages homes, and they're rarely within FEMA's mapped flood zones. There might be areas subject to mudslide, basically a liquefaction of the hillside, sudden land collapse caused by flooding. You're on a bluff or a high stream bank that is undermined by flooding. Flood insurance would cover that as well. So when can someone make a claim? Well, there's a definition of flood, which is a little more specific than what you might think. So it's the general and temporary condition of partial or complete inundation of normally dry land from the overflow of inland or tidal waters, or an unusual and rapid accumulation of runoff or surface waters from any source. The key point being it must affect 2 or more acres or 2 or more properties. If your neighbor's swimming pool collapses and damages your home, it's affected 2 or more properties, that's a flood. If the water main breaks and runs down the street and into your home, it's affected 2 or more properties, one of them being the public right-of-way. That's a flood for insurance purposes. So what about people that live outside of the special flood hazard area? We get enough people that live in the special flood hazard area that that think it's a scam and a crock, but the risk is real, and we can document that. But 25 to 30% of all NFIP claims are actually outside the special flood hazard area. We talked about the probability of a 500-year flood and that this is higher than the probability of a fire claim. So why does this happen? Well, flood maps look backwards, they don't look forwards. Flood risk changes, development changes flood risk. Development increases runoff, increases storm surge. Stream banks and shorelines erode, and so the flood zone can change. Sea level rise is happening. Some people don't believe it, but it's documented, it's measured, it's happening. We're getting increased peak precipitation events. The New York State climatologists estimate that as we get into the mid-21st century, what used to be the 100-year storm is now the 80-year storm. The 100-year storm does not necessarily equate with a 100-year flood. It depends on ground conditions, season, and soil moisture and so forth. So how to market? Well, there's something called a preferred risk policy. It's inexpensive compared to any of the policies that are within the flood zone. If there's a basement and somebody wants to purchase $200,000 of coverage, contents coverage is required as part of the preferred risk policy. It's not required for other policies, it's optional. But that policy right now costs $561. That includes all fees and it assumes that this is an owner-occupied 1 or 2 family structure. So the building must be outside the special flood hazard area. It must meet loss history requirements of no more than 1 insurance claim or 1 disaster relief benefit within any 10-year period. If they can't meet those requirements, but they're still in the X zone, they can still get an X zone policy. It's more expensive than a preferred risk policy, but less expensive than a comparable A zone policy. So, and I know I'm covering a lot of topics and I'm doing it fairly quickly, but I want to leave time for questions. And I might go slightly over the half hour if that's okay. So what's covered? What's covered by flood coverage? Well, obviously the building and the foundation. The parts that are intricate to the building, the electrical system, the plumbing systems, built-in central AC, furnaces, water heaters, refrigerators, stoves, dishwashers, subject to contents coverage. Any permanently installed carpeting over unfinished flooring is covered. Detached garages are covered, provided that they're no more than about 10% of the total coverage on the building. Debris removal is covered. Window blinds, basically anything that is permanently affixed to the structure is covered. Now, contents coverage, which is optional except for the preferred risk policy, does cover personal belongings, clothing, furniture, electronics, etc., portable appliances, carpets that are not permanently installed over unfinished floors, clothes washers and dryers, freezers, including the food in them, some valuables, not all valuables. What's not covered? Damage from moisture, mildew, or mold that could have been avoided by the property owner. I'm not entirely sure how they determine whether the property owner could have avoided it. Currency, certificates, precious metals, jewelry, property outside the insured building. It does not cover living expenses and does not cover your car or your recreational vehicle. However, a manufactured home is considered a permanent structure, and that would be covered. We're going to talk about basements, and there's a lot of confusion over basements, and for the purposes of this conversation, we're defining a basement as a portion of a building that has its floor subgrade on all sides. It's not a walkout. If you were to walk around the perimeter of the structure, there's something in the structure that is below grade all the way around. Many things are not covered in basements. Many things are. So foundation damage is covered. Damage to basically the appliances that serve the house, the furnace, water heater, heat pump, oil tank, circuit breaker, central AC, they're covered. The items with the asterisk, food freezer, washer, dryer, portable AC, they're covered if somebody has contents coverage. What's not covered in any case in a basement is improvements, finished walls, finished ceilings, finished floors, and personal belongings. The man cave down there, the big screen TV, are absolutely not covered. I remember after Sandy, I got a call from a woman down on Long Island who complained that much of her claim was rejected. Lives in a split level house. The kitchen was in the lower level, which was actually a basement because it was subgrade on all sides, and none of her kitchen appliances or cabinets were covered because it was an improvement in a basement. I'm going to talk briefly about increased cost of compliance. After a flood, it's something that you should be aware of and you should inform your clients of. So this started in 1994. It's an extra, an endorsement to the standard flood insurance policy that can be used to help somebody meet flood codes, modern flood codes. Most old houses built prior to the 1980s do not meet modern flood codes. To meet those codes, it has to be elevated, demolished, moved out of the flood zone, one of those. And increased cost to cover of compliance allows up to $30,000 towards that cost. Now, $30,000 is not going to go very far. However, if the community is fortunate enough to get FEMA mitigation funding, usually in the form of a hazard mitigation grant. That funding requires a 25% non-federal match. This $30,000 can be used to match that federal grant. The things you can do with ICC: elevation, floodproofing, relocation, demolition. That $30,000 has not increased since the 1990s. There's a lot of talk about increasing it, possibly at least to $60,000. In order to kick in, the local municipality must declare that the building was substantially damaged by flood. Now, there's been some controversy there because the law does not say by flood, but FEMA interprets it that way. So they won't issue the coverage unless it's been declared substantially damaged by a flood or repetitively damaged in a municipality that has a repetitive damage clause in their local law. Maybe only one or two in New York have that. So in recent years, Congress has been encouraging the growth of private flood insurance. The NFIP is deeply in debt. They're trying to give people an option and give insurance companies the ability to be a bit more creative in how they offer flood coverage. So for many years, private flood coverage was not available. There's better risk data yet. More insurance companies are getting into it. At least 50 insurance companies now offer some form of private flood risk. Again, standard homeowners policies do not cover flood, and I'm amazed every time there's a flood, and the local media in the given area would always have a story about somebody waiting for their insurance company to tell them essentially that, no, you don't have coverage, and people are surprised that their insurance, their homeowner's policy doesn't cover flood. Your homeowner's policy doesn't cover flood. It covers rain damage. It covers wind damage. It does not cover floods. So your clients should be aware of that. So federal law allows a private flood policy to meet the flood insurance lender requirements, but be careful. So here's some comparisons. Both of them meet federal requirements. The NFIP has a set waiting period unless it's part of a closing in which the policy kicks in, I think, in 24 hours. You cannot just go out there and say, gee, there's a hurricane coming my way, I better buy a flood insurance policy. No, it won't kick in for 30 days. There's a maximum coverage limit, $250,000 for a 1 or 2 family structure, $500,000 for everything else. The NFIP cannot be canceled. No matter how many times you file a claim, they can't cancel your coverage. And it's available anywhere within a participating community. There's also a FEMA mitigation program, specifically a flood mitigation assistance program, which is funded out of NFIP premiums. So structures would be available for that. Private sector, it meets federal requirements. It may have flexible rating periods. It may offer a higher coverage limit. It can be canceled. Some of the concerns from the very beginning is that some private companies might cherry pick in order to avoid the most at-risk policies. And these policies are not eligible for some FEMA mitigation programs.
Hey, Bill, I just want to jump in really quick. The calendar invite actually does allot an hour. So you still have a little bit of time. I'm not sure if everybody was aware of that, but just so you know that we'll be on for a little bit longer if people can still hang in there.
Okay, well, I've only got about 5 slides left.
Okay, perfect.
You mean I should talk a little slower, not use my New York voice?
No, you're doing good. I think it's perfect the way you're going.
Okay. So some final comments about NFIP versus private. With private, you might have more flexibility. NFIP, they'll cover anyone, anywhere. There's the third bullet is a sensitive one. The NFIP allows certain benefits for continuous coverage, including subsidized pre-firm rates. Pre-firm means that the structure was there before the first map in the community, generally an older structure with a basement. Now, you get a subsidized rate if that's your case, if you've never had a substantial damage or a substantial improvement, more than 50%. but that subsidized rate is continuous. It's not cheap, it's expensive. And that's why people get upset about it and look for alternatives. But if you leave the NFIP and get private insurance and then lose that coverage and you go back to the NFIP, you no longer get the benefit of continuous coverage, and your rates are going to go up much more rapidly. Again, NFIP offers cancellation protection and protection against many cost increases after a claim, plus increased cost compliance and flood mitigation assistance grant eligibility. In the future, there's a big black ball in the future that we don't know exactly what's in it. FEMA is working on something that they call Risk Rating 2.0. Those of us in the field have been arguing for years that the flood maps are binary. You're either in the zone or you're out of the zone. Flood risk doesn't behave that way. I've even seen, I was 60 Minutes, it was one of the national news programs, was doing an analysis of new flood maps, and I think this was in Los Angeles, and they had somebody that was standing on the sidewalk and said, okay, right here, I'm in the flood zone. And then he walked 2 steps and said, right here, I'm out of it. There was no difference. It was a flat place. This doesn't make sense. And yet, if you're an inch below the flood elevation, you're in the flood zone. If it's a pre-firm structure, you're paying $2,000 or $3,000 a year. Your risk may not be that great. And yet, if you're a risk an inch out of it, there's no mandatory insurance, or if you get insurance, it's very cheap, and you still have a risk. So what FEMA is attempting to do is to change the risk rating tables so that it's a continuous, the mandatory insurance would still be based on the special flood hazard area, but the rates would be a little more gradual. So what's probably going to happen is that structures that are towards the edge of that special flood hazard area in a shallower risk zone, their rates are likely to go down. However, structures that are deeper in the flood zone, that get more frequent flooding, that are closer to the source of flooding, expect their rates to go up. Also, FEMA has recognized that lower home values, less expensive homes, are paying more per value of the home than higher valued homes, and they're trying to address this. The rates will be based on the type of flooding, the distance from the source of flooding, and flood frequencies. Now, back in the 80s, FEMA tried to look at flood frequencies as part of their rate structure. Nobody understood it, so they walked away from it. But we won't know the details until the new rate tables are released. They're supposed to be released next April. They're supposed to come into practice in October. If I was to look in my crystal ball, my guess would be that the people that are hurt by this, whose rates are going to go up, their representatives are going to start screaming. Senator Schumer is no friend of FEMA, and I know that he will be looking at this, particularly with his New York City and Long Island constituents. So if I was to look into this, I would say that Congress is going to delay it. But this is right now what FEMA is saying they're going to do. We don't know how this will tie into mitigation. Currently, I can look at the rate tables and say, gee, if you fill your basement and elevate your house 3 feet, this is what it'll do to your insurance. I don't know what will happen with the new rate tables. I won't know it until I see the rate tables. They're going to eliminate the preferred risk policy, and they're going to eliminate the newly mapped policy, where if you have continuous coverage and you get mapped into a flood zone, you're grandfathered into a lower rate. The last time they tried to eliminate the newly mapped policy, Congress came back at them and said, sorry, you can't do that, guys. So stay tuned. This is what FEMA is saying. We'll see how it comes out. Finally, what's going on right now is that Congress has decreed that these subsidized rates for older structures must be phased out. And actuarial rates must be phased in. the actuarial rates for a home with a basement that's below grade can be very high. So this chart is based, and I did this a year ago. I haven't updated it this year, but it hasn't changed that much. So this assumes a primary residential dwelling, $200,000 of building coverage, $25,000 of contents. Let's say you've got a basement and your basement floor is 9 or 8 feet below the flood zone. You're going to be paying over $6,000 a year for flood insurance. And for many people, that's going to be unaffordable. So this is affecting sale values. I've already seen some analysis that in Houston, after Harvey, homes in the flood zone on the market fetch about 5% less than homes outside the flood zone. And there have been other similar studies. So this is it. This is my contact information. I'd be happy to take emails, take phone calls at any time, and we could be open to questions or discussion.
Thank you, Bill. And I did write in the chat box that this presentation is recorded, so we will have it posted on our National Flood Services website. And of course, we'll include all the information. And Bill, if it's okay with you, we'll send a PDF of the deck of the information that you have compiled for us.
Sure.
Cool. Does anyone have any questions? Feel free to unmute. You can put them in the chat box and we'll read them out to the group. Anything you want. We've got Bill live.
Can you hear me?
I can.
Oh, good. This is George Vasilla from Southern Tier 8. Quick question just about the actual definition of a flood. I've spent many years working for county planning in Pennsylvania, and again during flood, quote unquote disasters, you're answering the phone, and a lot of times the people calling are getting runoff.
You just, I heard you for a while and then I couldn't hear you.
I'm gonna have to try something else. I'm wondering about the difference in the definition of a flood.
George, we're not able to hear your audio.
I can hear it, but it's very quiet.
I think George, I might be able to help, or if you can't, if you want, you can type in the chat because I can barely hear you. Looking for the, oh yeah, you can, yep, you can type it. I can hear just at the beginning, he was talking about the definition of a flood. And I think he's looking for the difference between something, but he said he's going to type in the chat box for us.
In the meantime, I apologize for trying to throw so many different things in there. It's a complex program. I try to just skim the basics of it.
Okay. Define flood as rising up versus runoff into a structure.
Okay, so as long as there's water on the ground and a part of the ground that normally doesn't have water on it, and it affects 2 or more properties or portion or 2 or more acres, it's a flood. But if it's groundwater, you could have groundwater that rises up due to a condition of flooding and damages someone's foundation. But if there's no water on the surface at that location, it would not be considered a flood in terms of the National Flood Insurance Program. This was actually very controversial after Sandy because there were people who had damaged foundations due to the storm surge. And even though there was water on the surface, some of the claims adjusters were saying that, well, the damage was due to the underground forces of the water, not to the surface forces, and some of those claims were rejected. And this is the first time I had heard of it, and I dug deep into the flood insurance regulations, and they were right. It's not a good thing, but if the damage is caused by water that's beneath the surface, then it's not covered. So hillside flooding isn't flooding per se. No, if it can be sheet flooding down a hillside, as long as there's water on the surface. And certainly we've seen in hilly areas, we've seen damage. Pennsylvania, southern tier of New York, we've seen that. I remember seeing a picture of a building that was 3 foot deep with cobble that had run off the hillside. So yeah, as long as there's water on the surface and it meets that 2 acre or 2 property definition, then it is a flood.
Awesome. We got a thumbs up from George. Thanks, Bill.
Hey, Bill, it's Courtney from National Flood Services. How are you?
Fine. Hi, Courtney.
Good. Hey, I have a quick question. I know we've seen a postponement or a stall in the map change process due to COVID, and we can't have, town halls and gatherings and things like that right now. But do you foresee any major map changes in New York for 2021?
I think I'm going to bounce this to Tom Blanchard, who still works for DEC. I'm not sure if there's anyone else on the call that currently works for DEC. Because since I left DEC, I'm no longer up on the latest information on that. I know that they're working on some maps in some areas.
Yeah, Bill, they're coming up the Hudson, and I don't know how far along they are as far as restudying the Hudson and the counties that are adjacent to the Hudson River. In my area, that would be parts of Rensselaer and Columbia County. I don't know what's going on out in the western part of the state, but I think everything is pretty much stalled, like you said, because of all the COVID stuff and financing and all that.
Yeah, I know that they were working on Saratoga County and parts of Washington County. They were also beginning a project in the North Country in Essex, Franklin, St. Lawrence, those areas. Also in the Finger Lakes, they were working on, I believe, Livingston, Ontario, and Tompkins counties, and they're also working on updating all of the Great Lakes maps. So some of those counties that haven't been digitized are Chautauqua County along Lake Erie, and let's see, Orleans and Wayne and Jefferson counties along Lake Ontario.
It looks like right in from the looking at the group chat, it says, Brianna says remapping efforts are still moving forward. Meetings have been moved to a virtual platform.
Okay, excellent.
Question, how about Long Island? Any new mapping efforts on Long Island, New York?
Not that I'm aware of. Now, New York City did get a new preliminary map several years ago, and New York City challenged that map. They issued an appeal. New York City, one of the few entities that can come up with enough money to do detailed engineering. And I'm not an engineer, but I've become convinced that you can get 2 very capable engineers looking at the same problem and coming up with different answers, and neither one of them is necessarily wrong. So you can always get an engineer to challenge any kind of a study. But FEMA has gone back to the drawing boards. I know on the Atlantic Coast study, New York City, and down along New Jersey. I don't know what the timing was. When I left DEC, which was 3 years ago, they said it would be 3 years away, but that's in FEMA time. So I don't know where that is now. And if they come up with significant differences, and New York City may regret challenging it because the maps that were released did not include Sandy. The new maps will include Sandy in their analysis. I would guess that when they've come up with new maps for New York City and coastal New Jersey, it would make sense to extend the coastal analysis along Long Island, which was last done in, about 15 years ago, I think?
I believe so. Thank you.
We don't have anything coming in for the chat. Does anyone have any other questions? I think we might be all set for today. Bill, thank you so much for joining us and taking the time to create a presentation and be here answering all these questions. Like I said, we'll go ahead and post this on our website at nationalfloodservices.com. Just keep a lookout on that. I'll go ahead and put it in the chat.
And then we'll also send a follow-up email with that PDF.
Okay. And when we get that, we'll send it out to our state association membership as well.
Excellent. Thank you so much,
Awesome.
Bill. This was very, very helpful.
Thank you so much, everyone, for joining, and keep a lookout for more resources and tools, webinars that National Flood Services has to offer.
Thank you very much. This was very useful.
Great. Jillian, I love your round of applause. Thank you so much, everyone. Have a good rest of the week.
Thanks, Bill.